I'm Howie Lim. This is Money Hacks by the Business Times. Changes to the CPF Act were passed in Parliament on October 14th, which means the closure of the CPF Special Account, or SA, for members aged 55 and above will take place from the second half of January 2025. Okay, breathe. We knew this was coming. Prime Minister Lawrence Wong, then Finance Minister and Deputy Prime Minister, announced it during budget this year.
I'll be 55 years old next year. I just missed the boat to keep my money in special account after age 55. So I think while many people like me should be upset, might be upset, I think it is the only right thing to do.
Yay, Christopher Tan, CEO of Providend, is helping us out today on Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And if you have feedback or an idea for a podcast episode, do get in touch, btpodcasts@sph.com.sg.
Firstly, it's good to recap the changes. So there are two main changes. So firstly, for CPF members, it used to be that after 55 years old, after they set aside the full retirement sum in their retirement account, the excess amount can be kept in their ordinary account and special account to earn at least 2.5% and 4% per year respectively, and with liquidity, meaning to say that after 55, these monies in the OA and SA, they can take out anytime. But from early 2025 onwards, members above age 55 can no longer keep the funds in their special account. So the amount in special account, whatever balances they have in the special account after 55 will be transferred to the ordinary account. Thus, the amount in SA, which would have earned at least 4%, will now only earn 2.5% in OA, which is 1.5% lesser. Then they're going to close the special account. And the second one would be that from next year onwards, CPF members who are age 55 and above can top up their CPF RA up to enhanced retirement sum, which is currently 3 times of the basic retirement sum. So this year, members above 55 years old can still top up to about 308,700. But come next year, the change is that they can top up, not compulsory, up to 4 times of the basic retirement sum, which next year, the 4 times of BRS will be 426,000. So these are the two changes.
And we heard from you earlier, you don't seem too fussed, right? What are your thoughts on the changes?
My thoughts? Well, Howie, I'll be 55 years old next year. I just missed the boat to keep my money in special account after age 55. So I think while many people like me should be upset, might be upset, I think it is the only right thing to do because these changes only really affect a small group of people, the affluent, the CPF rich people. These are the people that will be affected because only these people have so much money in their CPF that after they transfer everything from their OA and SA to RA after 55, they have still a lot of money left in their OA and SA. CPF is really meant not to take care of the people who are very rich. I mean, we want to take care of them, but it's really meant to take care of the people who are less affluent. And currently, it is not aligned with investment principles. So currently, before the changes, you get 4% from your special account, which is pretty good because it's guaranteed at least 4%. Right now, it's higher, but at least 4%. But you get full liquidity. And we know Investment 101 is that if you want to get higher return, you cannot have that liquidity. Both your OA and SA, they have full liquidity, but OA, you're only getting 2.5. SA, you are getting more. So they are just making that adjustments. Well, as much as I just missed the boat and I should be very upset about it, but I think it's the right thing to do.
Sounds reasonable. What's with the uproar hoo-ha then, Chris?
Many people, when the government first made these changes, they know that actually the main purpose of this change is to stop this thing called CPF shielding. So I'm going to go slow because it can get a bit complicated. So let's say you have 150,000 in your OA and 250,000 in your SA. Just before the age of 55 years old, because you cannot invest the first 20K from your OA, you will now invest 130K from OA into a low-risk instrument like a money market fund. That's your OA. For your SA, because you cannot invest the first 40K, you will now invest 210K from your SA into a similar low-risk instrument. That's the first step. Then you turn age 55, here comes CPF board. They are going to attempt to take the full retirement sum amount, which this year is 205,800 from your SA first. But when they try to do it, they only see 40,000, right? So they will just transfer whatever that is balanced. So 40,000 from your SA to your RA. Then they will try to take the remaining of the full retirement sum, which is 205,800 from your OA, but they can only find 20K left. So they're just going to transfer 20K from OA to RA. So after your 55th birthday, your RA will now have 60,000. Then the next step that you do is that because you want to top it up, you actually want your RA to have the full retirement sum amount of 205,800. So now you take from your bank account 145,800 of cash, and then you top it up into your RA, and so you get 205,800. After all that's done, you sell all your investments. So you sell your SA investments, 210,000 will now go back to SA. You sell your OA investment, 130,000 will now go back to your OA. So at the end of this whole entire exercise, you now have 130K in OA earning at least 2.5. You have 210K in SA earning at least 4%. With full liquidity, you can take out, it's like bank account, you can cash it out anytime. So people like this because you can see the reason. Now they have full retirement sum and RA, they have a lot of money in the OA and SA, and they have full liquidity. It's like a perfect bank account. But with the changes, no more. Whatever in the SA, the 210K is going to be transferred to the OA. They're just going to close the SA. So this is the CPF shielding that we are talking about. Well, when the government did this, it just killed this shielding.
Oh, closing loopholes. Kind of quah, right? I mean, why, in your opinion, was this done?
From the government standpoint, closing the SA achieves two purposes. So the primary purpose of CPF is for retirement, really. So allowing one to keep money in a special account after age 55 with full liquidity is not aligned to that purpose because people can take out anytime. And after age 55, if they really want it to be for retirement, I mean, they can always transfer money from OA to RA, which is meant for retirement. What the government doesn't want is that they don't want you to take out anytime you want because that goes against their purpose of providing retirement adequacy for the long term. Closing the SA achieved the second purpose. And the second purpose is, as I mentioned, it aligns with investment principles. If you want a higher return, you must accept lower liquidity, which is the RA. And if you want more liquidity, Investment 101, you need to accept lower return, which is the OA. So keeping the SA open after 55 breached this principle. And so therefore, well, the government decided to close it.
Lovely. I think I'm more confused than when we started the podcast. More with Christopher Tan, CEO of Providend, about the CPF changes due to kick in 2025 in a moment.
If you've been a fan of the podcast Mark to Market, Wealth BT and Property BT, they are moving to a new listing, BT Correspondence. Look for episodes every Tuesday from October. All the insights and analysis and market trends, property, wealth, and soon mobility too. Powered by the Business Times journalism of Genevieve Kwa, Leslie Yee, Ben Paul, and Darren Wong. Because great reads should be heard. The BT Correspondence channel. Find BT Correspondence wherever you listen to podcasts.
And now, back to Money Hacks from the Business Times.
We're speaking to Christopher Tan of Providend today, who's helping us make sense of the changes to CPF which are due next year. Chris, I'm really confused, to be honest, and I think many people are as well. Why does it have to be so complicated?
Yeah, it is confusing. I'll tell you, Howie, if I don't talk about CPF for maybe a few months, I forget my numbers, even for me. Something that I deal with it often. So I forget certain policy thinking and all that. So it is confusing because firstly, the CPF scheme, we want flexibility and we want choices. When we want to choose the CPF Life, there is the basic plan, the standard plan, the escalating plan, all that. When I was with the CPF advisory panel in 2014, I was told that people wanted an escalating payout option. So we have to add one more plan. And every time you add a plan, it adds on to the complexity. So that's one. Secondly, there are changes to the needs of the people. When we first decide to size the basic retirement sum years ago, when I say size, I mean how much should the basic retirement sum amount be? We were thinking about people in the second quintile group in the population based on their monthly expenditure. So we are talking about back in 2014, people who need at least about $500 per month to survive, the lower income, right? So that at 65 years old, the amount that they get from their CPF life will give this second quintile group an equivalent of $500 when they were 55 years old. But today, Singaporeans are getting more and more affluent, and just allowing people to top up to 3 times of the BRS when they are 55 years old may not be enough. The CPF life amount may not be enough. Based on the current ERS, which is 3 times of the basic retirement sum amount, they get about $2,000 a month from age 65. And if it's a couple, it's about $4,000 a month. And Singaporeans are really saying, how am I going to survive with $4,000 a month? I want to travel and all that. Therefore, we have to make one more change. So we allow people to top up a bit more if they want to and if they can, to 4 times of the BRS. And if they do that, they can do that next year. At 65, then they will get about 2,600. So as a couple, you get 5,002, which is a bit better. So because of all these needs, and flexibility of the schemes, the CPF is indeed very confusing and you don't deal with it every day.
Okay.
So what advice do I have people who are confused? Okay, I hope this is not even more confusing because it is not easy to give advice over a podcast. What we should do will really depend on what was your original intent for the money in SA after age 55 had there been no changes. If your original intent is meant for it to be in SA for the longer term, that means you say that, no, even if you don't close my SA account, my money, I'm not going to touch it. Then my advice is members can choose to top up their RA up to 4 times BRS. They can now transfer their money from OA to RA up to 4 times BRS because anyway, it's meant to be for the long term. They don't need the money immediately. Transfer it to the RA up to 4 times BRS, and they can transfer money from OA to RA, or they can transfer money from cash to the RA. So they have options. Of course, where they have to accept a loss of liquidity because once they transfer to RA, then they are not supposed to take it out. So that's the first thing. Now, if the original intent of the money in the SA was meant to be set aside as reserves, that means no immediate use. So what they can do now with the closure of the SA is that they can, because now the money in SA is going to be in OA, they can choose to invest a portion of the money now in OA into higher risk instruments such as equities, but they must have the ability to stay invested at least 10 to 15 years. So if it's for reserves, fine. And now the final group of people, the people that you need to draw down immediately for use, had there been no changes to this whole thing. And I'm just going to show you that actually it's not going to really affect you much. So if you have 200,000 in your SA after age 55, assuming you want to withdraw $3,000 per month, adjusting for 3% inflation, your SA balance will last you for about 5.7 years. But if the change, all your money is going to go into OA, earning only 2.5%, this same 200,000 will last you 5.5 years instead. It's just 0.2 years, which is no big deal. That's my advice. 3 different groups of people. I know there are a lot of numbers. You probably have to re-listen to this, take out some papers and write it. Hopefully that's helpful for them.
No, Ken, I think I got it. Phew. Will this advice change, though, for someone who's at a different life stage, younger maybe?
Yeah, I guess if you are younger, meaning below the age of 55 years old, these changes, they don't affect you at all. Life goes on as per normal. The SA is not going to close. You are not reaching 55. You can't top up your RA up to ERS anyway. So I would say for the younger age group, meaning to say below 55, these changes will not affect you. For the affluent, it really depends on the original purpose of the use of these OA and SA. If you are more affluent, then consider some of the steps that I have shared with you earlier on.
How effective will the changes be in helping with retirement adequacy, Chris?
Well, firstly, we need to understand that these changes mainly impacts the more affluent because only the more affluent will have so much CPF balances in their SA after setting aside the full retirement sum. Majority of the CPF members will not have so much left in their SA. And for the affluent, they would have other avenues of planning for their retirement. And so I don't think it will affect retirement adequacy of the affluent. I think the issue here is not whether this is a better way for long-term savings, because some members will argue that they are also keeping their monies in SA after 55 for the long term. From the government standpoint, perhaps allowing SA to be around after 55 really only benefit the wealthier, which again is not in alignment with the purpose of CPF. I think for the less affluent, whether or not it is adequate for your retirement depend on your spending needs. And if you just manage to accumulate up to full retirement sum at age 55, you have no more money to top it up, well, you have to ask whether 1,500 per month when you are age 65 or about 3,000 as a couple is sufficient. I wouldn't say it's going to give you a luxurious life, but I think for basic living, it is fine. Of course, these numbers that I've used, I'm assuming people who are 55 years old today, if they meet the full retirement sum in their RA as a couple in 10 years' time at 65, they are going to have about $3,000 as a couple.
Is there anything we need to know about, do, be prepared for as these changes loom?
It's a bit sensitive to say this, but I know people don't like these changes. I mean, people don't like changes, right? Well, things have improved a lot. I remember 2014, there was a big group of people like, give me back my CPF. I just want to manage it myself. I think it's getting much better now. But even if you dislike the government from making all these changes and forcing you into the corner and you cannot take out the money and all that, I would say I look at CPF as a financial product independently. And if I look at it as a financial product, there aren't anything at all in Singapore based on Sing dollar that can give you a 4% guarantee. And your capital is also guaranteed. And the issuer of this particular financial product is a AAA rated quote unquote company, right? I mean, Singaporeans buy insurance products from insurance companies and they aren't even AAA. They cannot guarantee your principal and they cannot even guarantee 4%. And we buy them, right? But if we look at CPF as a financial product, AAA rated, at least 4% guarantee, it is actually a pretty good financial product. If you are below 55, if you have not reached your full retirement sum yet, this year is 205,800, I will say top up your SA up to the full retirement sum. If you don't have the lump sum, just like you save $100 per month buying an endowment plan, why don't you just top up your special account $100 every month? If you can afford more, top up more. Just think of it like a super good endowment plan, right? And if you do that, you are going to have a very healthy SA when you reach the age of 55. Your retirement adequacy will be much, much better. And for those of us who are, whether or not we are 55, well, the other scheme, if you want to top up your OA with more money, there is this thing called the housing refund scheme. How much money you have used from your OA to pay for your house. Today, if you have cash in the bank and you are not doing anything about it, instead of keeping it in the bank, you can actually top it back into your OA up to the amount that you have used from your OA to pay for your house. In this way, you are allowing your money, your cash to earn 2.5% instead of leaving it in the bank and earning lower than that. And finally, if you are age 55 and above, you can consider topping up your enhanced retirement sum up to 4 times BRS. My only caveat to that, don't top it up to a point whereby you have no more liquidity. So if you have only got 200,000 and you got to top up 200,000 to make the 4 times BRS, don't do it because then you have no liquidity. Everything is stuck in the RA. But otherwise, if you want to have a higher payout, top up to the ERS. And when you reach 65 years old, if you want to have a higher payout, well, my advice is choose the standard plan. And if you don't need money at 65 years old yet, delay the payout. The last age of withdrawal is 70. Every year of your withdrawal, your monthly payout is about 7% more than the previous year. So these are some advice I would say for people of different age group, different needs.
Always good to speak to you. Thanks for your time.
Most welcome.
Christopher Tan, CEO of Providend. And don't forget to send us an email if you have feedback or an episode idea, btpodcasts@sph.com.sg. I'm Howie Lim, and this has been Money Hacks from the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.